Hi, I'm Liz Hampson, editor of Property Week, and I'm delighted to be joined today by Poole, a partner at Mishcon Reya, one of the lead partners in our Climate Crisis Challenge campaign. During today's In Conversation With, we're going to discuss one of the hottest topics on the ESG agenda at the moment, green finance, which has taken off in the past year as investors increasingly look to build greener portfolios and lenders increasingly focus their lending strategies on sustainability principles. The use of green finance is only set to grow further as we race to net zero carbon. But as we will hear from Omega, although there are many rewards, there are also challenges and potential pitfalls involved. Omega, what are the benefits of green and sustainability linked loans? And for the uninitiated, what's the difference between the two?
Should we start with your second question, Liz? So terminology has changed over the last few years, but in simple terms, green loans are those loans where the loan proceeds themselves are used for the green project and the project is assessed and measured in that way. Sustainability linked loans, on the other hand, the proceeds from the loan can be used for general corporate purposes, but the loan mechanics incentivise the borrower in some way based on ESG KPIs. So there's a subtle difference, and you could in fact have the same loan have both green and sustainability linked characteristics. So what are the benefits of green and sustainability linked loans? Well, I think we're all of the mind that they play an increasingly important part in supporting the real estate market to improve the sustainability characteristics of our property stock. But there are also benefits for lenders themselves. Investors in those lenders are increasingly focused on ESG criteria, so there's a spotlight put on lenders by their own stakeholders. It might be easier to syndicate a loan if it has sustainability linked or green characteristics, as other lenders also want to increase their books of these kinds of loans. And lenders also have their own sustainability criteria to meet. One point I think is worth flagging up front, though, is although it's obviously important to have these loans in the context of new buildings, which maybe we could build with BREEAM Excellent or other appropriate criteria, it's arguably even more important to be using these types of loans for transitioning existing stock from its current state to a more sustainable product.
And how easy is it to do that, to get these loans for existing stock?
So a number of lenders have actually have products that are specifically designed to support the transition of stock from existing stock to new stock. Aviva's a good example with their commitment of £1 billion, big number, of loans in the next 4 years for exactly those kind of assets.
So you're starting to see more of that coming through now. And has it been a battle to convince people of the merits of applying this to existing stock, or were lenders knocking on open doors?
So all of the conversations that we have with lenders, they're very focused on ESG generally, but they're obviously also at quite different stages of their own thought process. So some lenders are at the stage that they're encouraging or requiring their borrowers to complete very detailed due diligence questionnaires around ESG requirements, but they might not actually have specific KPIs in their loan documentation, so no specific green covenants, so to say. Other lenders, like Aviva that we just mentioned, are actually designing green and sustainability linked products which require borrowers to sign up to certain pre-agreed KPIs as part of the loan. And they oftentimes get incentivized by a margin ratchet for having met those pre-agreed metrics.
That's really interesting. And what types of green and sustainability linked finance options are there in the market at the moment?
So the two main areas, I suppose, are the bilateral loans, which often get syndicated afterwards, but also there's an increasing focus on green bonds, and we're seeing more and more green bonds being issued. And in fact, organisations, for example, the EBRD, who traditionally may have focused more on bilateral loans, are really focused now on green bonds as well.
So it sounds like there's plenty of product out there, but there are obviously challenges involved in taking out one of these loans, or indeed in lending money that's sort of with this green and sustainability metrics involved. What are some of the practical challenges?
Probably the main practical challenge, which already alluded to, is really setting meaningful KPIs. So the LMA has set some really useful guidance for borrowers and lenders alike about what these metrics should look like. And they make it very clear they should be ambitious and meaningful. They've also suggested considering using a sustainability coordinator. So it could be the case, particularly at this relatively early stage in the market's development, that the lenders and borrowers themselves don't have in-house expertise to identify the right metrics, so they can work with an external third-party consultant or certifier that can help them set these types of metrics. Another challenge that we talk about a lot in various contexts in property is obviously the standardisation of data that is collected at a property or an asset management level, and that can itself present challenges. But some lenders have solved for this problem of setting KPIs with developing their own pretty robust and rigorous frameworks, and they might also bundle KPIs into those which are considered higher priority and those which are, say, more medium priority. So, for example, higher priority KPIs could be around energy efficiency with the use of smart meters or LED lighting, or perhaps using energy from more sustainable sources, renewable sources. And then the KPIs could be set by reference to a specific energy saving benchmark. Another high priority KPI could be around reduction in target emissions, again with KPIs set by reference to an annual carbon intensity metric. And then, say, medium priority KPIs could be around how a tenant fits out their property and the percentage of material they use from renewable sources, or indeed, say, the number of car parking places they have that are for electric vehicles. And as I mentioned, KPI,
Sorry, no, keep going.
So lenders and borrowers can use external consultants to help them find the right metrics for their KPIs.
And obviously a lot of focus at the moment on the E, but what about the S and the G? Those are potentially more challenging, aren't they?
They are. And so when we speak to lenders, they make exactly that point. It can be harder for them to measure the S and the G, although not necessarily impossible. So one of the key areas which a number of lenders have flagged to us is around wellness. And there are various certifications to measure wellness associated with property use and occupation. But even though it is actually, it could be harder to measure these KPIs, lenders are still very focused on how they can incorporate them into their green and sustainability linked loans.
And what about the concerns over the financing of capex requirements to meet these new ESG criteria?
One or two borrowers have raised with us this exact question. So they say, how do we finance capex to improve the sustainability characteristics of our assets, which may, of course, require having vacant possession over all or part of the building and therefore loss of income? And these capex requirements, they argue, might not necessarily lead to an immediate uptick in income through the rental stream, or indeed an increase in values. But indeed, a number of lenders are looking at how they can offer value-add financing options that really would enable borrowers to secure financing to make these capex investments.
And there are some other challenges involved, aren't there? I mean, it's quite different when you're talking about real estate to, say, corporate loans.
That's right. So if we think about real estate loans are obviously targeted at financing specific properties or portfolios of properties, which is quite different from a corporate loan. And one of the challenges which lenders face is they don't want to be financing, providing a sustainability linked loan where the KPIs are set just at the asset management group company level, and actually they're taking the risk on financing an individual property or pool of properties, but there aren't potential benefits around improved sustainability characteristics of those properties themselves. So they typically want to ensure that there are at least some KPIs that are directly attributable to improvements in the properties themselves rather than just at the corporate level. However, on the flip side, if you ask a lender if they want to finance a property that's got fantastic ESG credentials, but there's some big question mark on an ESG metric at the corporate level, then they're also increasingly likely to say not for them.
And what about this danger of greenwashing that I think is creeping in? And we've seen so many claims made, haven't we? And so many people companies making commitments to ESG, and now an increasing number of lenders. What is the danger greenwashing? How many of these loans are not really what they're cracked up to be?
So I think we really need a sense of balance here, because as an industry, we want to be encouraging lenders as they move through their thought process and try and incorporate more and more ESG criteria, encourage their borrowers to, so to say, do the right thing. On the other hand, it can't just be the case of business as usual. So really, I think the acid test is these new requirements, the new capex that's required, is it over and above what would be business as usual? And if so, then there's a meaningful change being made.
Okay, and do you see that actually coming through? I mean, you're looking at some of the details of these loans now. Are they over and above?
They are, and so sometimes it's the case of how much is actually being done, and sometimes it's a case of accelerating the time frame. So for example, if a change would typically take 5 years to improve a building on an ESG metric, maybe energy consumption, for example, but the borrower commits to do that change in 1 year or 18 months, that's quite a meaningful difference in terms of the overall time for delivery. So that in itself could be a meaningful change. So we are seeing lenders being really critical about how they scrutinise what the borrower is signing up to do.
I mean, the hope is you see more and more of these introduced, isn't it? What needs to happen now in terms of government next steps and industry next steps to see green loans really take off?
So I think we're expecting there to be much more by way of disclosure. So we see that there's regulation in the pipeline that means that there's going to be a lot more transparency in the market. So that's perhaps part of the stick for the carrot and stick equation for the government. So one example is the UK government and regulators' implementation of, is quite a mouthful, the recommendation of the Financial Stability Board's task force on climate-related financial disclosures. And we know a number of meaningful changes are required to take place by 2025 and actually a number by 2023. But consider whether the government should also be providing more of a carrot, perhaps in the form of incentives to lenders who are willing to write these loans where there might be a margin ratchet to reward good behaviour by their borrowers. On an industry level, I think we've seen a number of lenders really step up to the plate, either with bold commitments like Aviva or HSBC or Lloyds, or indeed sharing best practice. So for example, Aviva have taken the step of publishing their sustainable transition loan framework so everybody can see exactly how they're going about writing these loans. But there's obviously two sides to the coin when you come to a financing transaction, and the borrowers themselves could be more proactive. So when borrowers are thinking about financing their assets or refinancing their assets, they could ask themselves, are there any ESG improvements I could be making to my properties? And if so, should I be having a conversation with my lenders around whether a sustainability linked loan or a green loan could be the right financing option for me? And hopefully working together with the support of their lenders, we'll see more and more borrowers commit to materially improving their ESG credentials of their existing stock.
And where are they at now, that the borrowers, do you think? I mean, are they at the beginning of the journey, sort of halfway through? What's your read on that?
It's a very mixed picture. So we see some big institutions that are really ahead of the game, but obviously the market, as we all know, is made up often of quite fragmented owners and operators of property. So I suppose one message that we could be getting out there is to encourage those owners and asset managers to really raise the points with their lenders about whether they could be making some improvements, potentially getting a small saving on the cost of their financing, but also doing the right thing in terms of helping to improve the credentials of the property industry as a whole, as it's such an important question for us all.
And what about smaller players? Because I think they'll be thinking it's all very well, you know, a big player sort of going ahead and developing this incredibly sophisticated sustainability strategy and sort of implementing those metrics, but a smaller player will be thinking where to start. Where do they start?
So that's probably where the use of external consultants can be quite helpful. And and working with their lenders. So lenders are getting more and more sophisticated about how they underwrite these types of loans. So borrowers, if they raise the question with their lenders may either have in-house capability around how to create the right metrics for ESG, or will already be working with third-party certifiers. And so the borrower doesn't need to do all of the heavy lifting on this by themselves. It could well be a dialogue between borrower and lender to try and work out whether their property is suitable for a sustainability linked or green loan, and then what are the right metrics. And as lenders do more and more of these loans, they'll be able to help direct the borrower to what might be appropriate based on other transactions that they've done.
And how much progress do you think has been made with regards to these 2023 and 2025 government targets?
I think we're gradually making progress, but it's still a slow journey. And so the question is how focused some of the smaller participants are on these targets. I'm not sure they're getting the right headlines that they should be in terms of focus. And it's certainly one thing that we've been raising with our clients and contacts more generally, to focus them on the regulatory side and what's coming down the pipe. Also, it's worth noting, of course, that many lenders in the market, for example, also need to keep in mind EU requirements because they may be working on a cross-border basis. And so obviously the EU rules around taxonomy and disclosure regulations also could impinge on the way that they do business.
And how prevalent do you think green finance is going to be then in, say, 5 years' time? Do you think it will be a mainstream product, or is it still going to be fairly niche?
I suppose my hope is that more and more lenders will move towards incorporating ESG as a day-to-day part of their underwriting. If you ask a lender now, will they finance a building just because it has fantastic ESG credentials? The answer is obviously no, because they need to make appropriate risk-adjusted returns for their own investors. But more and more, if you ask them, will you finance a building that has got fantastic potential returns for your loan, but actually fails on some major ESG criteria, then increasingly lenders will say, we don't have appetite for that. So I think we're going to see a gradual movement towards loans day to day taking into account ESG criteria, and more products which are specifically green or sustainability linked.
So your hope is that that's going to happen, and you think that is going to happen, or do you think we'll only be sort of some way towards where we need to be within 5 years' time?
So the direction of travel and momentum is definitely going in the right direction. So all of the lenders that we speak to are saying that they're very focused on this. And if you think about it, just from a hard-nosed commercial perspective, it makes a lot of sense, because they want to have security for their loans, which is not going to have an increased risk of obsolescence compared to other properties, and will continue to maintain its value. And if we see how the market is evolving more generally from an investment perspective, we know that investors are more focused on those assets which have good ESG credentials. So even if a lender wasn't minded to do the right thing simply for doing the right thing, from the purposes of the value of their collateral for the loans that they're taking, it makes sense for them to be very focused on sustainability and ESG criteria.
And if there was one thing you would single out that the industry should be doing right now to get on board with all of this, what would that be?
I really think it's borrowers picking up the conversation with lenders. We're seeing a lot of focus on the lender side, but I'm not convinced that borrowers are so alive to these issues, or perhaps not even don't even recognise that their property could potentially fit within one of these financing structures.
Listen, thanks very much, Omega. That was really fascinating. I think you gave some practical insights of next steps that need to be taken. But it seems that the direction of travel is very much that we're going to see more of this sort of finance coming through, and that it's going to become a bigger niche, if not mainstream. Thanks very much.
It's a pleasure.